What drives me crazy is watching people treat investing like entertainment while their financial operating system is already infected. They buy a little stock, a little crypto, a little excitement, and then wonder why nothing changes. They stare at charts on a glowing screen while a credit card charges 22% interest in the background, month after month, like a silent predator eating the future. They ask me which asset will make them rich, while they do not even have enough cash set aside to survive a broken transmission, a medical bill, or a layoff. That is not investing. That is cosmetic finance. That is installing a pretty app on a corrupted machine. If you get the order wrong, the numbers punish you, not emotionally. Not philosophically, mathematically. Most people do not have an investing problem. They have a sequence problem. They are trying to harvest fruit from a tree whose roots are still on fire. They want the upside of ownership without first securing the basic permissions that allow capital to survive long enough to compound. They want to feel like investors before they have earned the stability to behave like one. I have spent most of my life around capital, and capital has a cruel habit. It rewards order. It punishes disorder. It does not care how excited you are. It does not care how intelligent you sound at dinner. It does not care how many market opinions you can repeat from television. It only cares whether your financial system is built in the correct order. That is the part people resist. Because the correct order is not glamorous. There is nothing glamorous about cash sitting in reserve. There is nothing glamorous about destroying high-interest debt. There is nothing glamorous about reading the fine print on an employer match or studying the tax treatment of a health savings account. But glamorous is what poor strategy looks like from a distance. You can look sophisticated while bleeding out. I would rather look boring and get rich. That is one of the most expensive truths in money. The boring layer is usually the layer doing the real work. The flashy layer is often just noise sitting on top of it. So when I think about the proper order for building wealth, I do not think in terms of tips. I think in terms of an operating system. If the kernel is unstable, every app crashes. If the permissions are wrong, the good tools cannot help you. If background processes are eating memory, it does not matter how beautiful the screen looks. Your financial life is no different. The first layer is not return. It is survival. You need what I call a survival floor. Most people are living without one. That is why they make desperate decisions and then tell themselves those decisions were strategic. They were not strategic. They were forced. There is a difference. A forced seller is not an investor. A forced borrower is not free. A person with no cash buffer is living with invisible financial blackmail. I have seen people with brokerage accounts, retirement apps, and opinions on artificial intelligence who do not have enough liquid cash to absorb a single ugly week. That is absurd. A market decline does not destroy most people. A life interruption does. The market can recover. Your judgment during panic often does not. An emergency fund is not just a pile of money. It is a circuit breaker. It keeps a temporary shock from turning into permanent damage. That is why I do not treat this layer as optional. I do not care how badly you want to buy stocks. I do not care how attractive the market looks. I do not care how many people online are screaming about the opportunity of the decade. If your system has no survival floor, your first job is not to chase upside. Your first job is to become hard to kill. For many people, that begins with the first $1,000. Not because $1,000 will solve your life, but because it changes your psychology. It interrupts the panic reflex. It proves that not every surprise must be handled with debt. Then you push toward 1 month of living expenses. Then you push toward 3 months. If your income is unstable, if you freelance, if your industry is volatile, if you carry family responsibilities with no real safety net, you may need more. The correct amount is not a moral number. It is a pressure number. How much shock can your life absorb without forcing a bad decision? That is the real question. I have seen research showing that even a modest buffer changes behavior dramatically. People with a couple $1,000s in emergency savings do not just have more money, they have more room to think. That room matters. Financial well-being is not only balance sheet arithmetic, it is the ability to avoid stupid decisions when a bad Tuesday arrives. When people skip this layer, they become accidental gamblers. They are always one surprise away from liquidating assets at the wrong time, borrowing at insane rates, or sabotaging years of progress because their system had no shock absorber. They tell themselves cash is lazy. I tell them cash that prevents panic is one of the highest returning assets they will ever own. Once that survival floor exists, the next enemy becomes obvious. You must eliminate what I call interest fire. People love discussing investment returns because returns are flattering. Interest expense is humiliating. It reveals disorder. It shows that somebody else is compounding against you while you pretend to be compounding for yourself. Credit card debt is the cleanest example. A 22% annual interest rate is not a mild inconvenience. It is a financial emergency wearing ordinary clothing. If you are carrying that rate while dabbling in the stock market, you are not investing. You are playing a fence with one hand while your house burns behind you. I want you to understand how brutal this is. A guaranteed 22% drag is harder to overcome than almost any sensible investment return you can expect. Up to taxes and human error, people fantasize about earning 10% a year in the market while ignoring a guaranteed negative 22% sitting on their balance sheet. That is like celebrating a garden hose while a fire truck empties your reservoir. I do not say this to shame you. I say it because numbers are not sentimental. If you owe $5,000 on a card at roughly 22% and you crawl along making minimum payments, you can spend years donating thousands in interest to a bank for the privilege of staying stuck. Every dollar used to extinguish that balance is earning a risk-free return equal to the rate you are no longer paying. People chase that kind of certainty in markets and never find it. Then they ignore it on their kitchen table. Debt changes character depending on price. Cheap long-term fixed debt attached to a productive asset is one thing. High-interest consumer debt attached to yesterday's impulse is something else entirely. I am talking about the second kind. I am talking about anything expensive enough that it is mathematically strangling your compounding engine. Around 8% and above, you should start paying very close attention. Well, above that, the decision is not subtle. Put the fire out now because human beings need traction, not just theory. I prefer a ruthless sequence. Make the minimum payments everywhere. Then throw extra cash at the highest rate debt first. That is the avalanche. It is not exciting. It is simply more efficient. Some people prefer the snowball because quick wins help them stay engaged. Fine behavior matters, but do not lie to yourself about the math. The avalanche usually saves more money. The point is not to choose a cute label. The point is to stop feeding lenders your future. This is where many people expect me to say, pay off every bit of expensive debt before you put a dollar into investing. And most of the time that instinct is right, but there is one gate in the operating system that you should not leave unopened. I call it the free money gate. If your employer offers a retirement match, contribute enough to capture the full match even while you are still killing high-interest debt. That is one of the few exceptions in personal finance that deserves its status. The reason is simple. An employer match is an immediate return so large that it overwhelms almost everything else. A 50% or 100% match is not theory. It is a direct transfer. It is free capital tied to your own discipline. You would be amazed how many people walk past it. They complain about not getting ahead while their employer is literally offering to increase every invested dollar, and they decline because they never bothered to learn the rules. That is not bad luck. That is a permissions error. Suppose you earn $50,000 and the company matches 50 cents on the dollar up to 6% of salary. Your contribution of $3,000 pulls in another $1,500. That is an immediate 50% lift, before the money even begins compounding. No stock picker can promise that. No television host can hand you that. No market guru can create that out of charisma. It is already sitting there waiting for a form and a little maturity. Now, I am not telling you to gorge on retirement contributions while a credit card devours you. I am telling you to open the free money gate just enough to claim the match, then turn back and finish killing the interest fire. That is sequence. That is discipline. That is how adults allocate capital. You do need to understand vesting rules. If the company requires time before the matching funds become fully yours, read the terms. But even then, most matches are too valuable to ignore. The bigger lesson is that wealth is not only about how much you earn, it is about how many valuable systems you fail to activate. Once you have a survival floor, once the interest fire is either gone or under concentrated attack, and once the free money gate is open, your financial operating system starts behaving differently. Now you can move into a layer most people badly misunderstand. I call it the tax shelter stack. This is where ordinary savers lose astonishing amounts of money, not because they lack effort, but because they operate in the wrong environment. They save inside the most exposed containers, then wonder why the machine feels heavy. Taxes are friction, fees are friction, bad account sequencing is friction, and compounding hates friction. The first thing I want you to understand is that not all dollars are equally intelligent. A dollar invested in the right tax structure can work much harder than a dollar invested in the wrong one. If you ignore that, you will spend decades producing gains that are quietly siphoned away before they get the chance to snowball. This is why I would rather see a person fully understand their tax-advantaged options than memorize 20 stock tickers. They do not understand after the employer match. I like the IRA layer. Why control, simplicity, lower drag. Many employer plans are cluttered shelves full of mediocre funds and fat fees. They are the financial equivalent of a cafeteria where every meal is overpriced and half the menu is bad for you. An IRA often gives you better choices, broader access to low-cost index funds and exchange-traded funds, and far more control over how your capital is deployed. Fees matter more than most people think because fees are one of the few certainty factors in investing. Future market returns are uncertain, your emotions are uncertain, tax policy is uncertain. But if a fund manager charges you 1% or 2% every year, that drain is very certain. Over decades, small annual leaks become enormous missing fortunes. Most people will never see the money because it disappears slowly. Slow disappearance is how the rich avoid public outrage. So if you can put money into an IRA and choose low-cost broad exposure, you are often creating a cleaner environment for compounding than a crowded, expensive workplace plan. For 2025, the limits are meaningful. Under 50, you can put in $7,000. At 50 and older, $8,000. Those may not sound like heroic numbers, but consistent annual contributions in a protected environment can become very large if you respect time. And now we arrive at another question that confuses people because they want certainty in a world that rarely offers it. Traditional or Roth, I do not get religious about this. I get practical. The real question is not which one sounds smarter at parties. The real question is whether you would rather pay tax now or later, and under what conditions, if you are in a lower bracket today and expect higher income or higher tax rates later. Roth often looks attractive because you pay at today, smaller bite and protect the future growth. If you are in a high bracket now and likely lower later, traditional contributions can make excellent sense because the deduction today is more valuable. But prediction has limits. Most people do not know exactly what their retirement tax situation will look like. That is why I respect tax diversification. Splitting between the two can be rational, because flexibility is valuable. Optionality is an asset. A rigid ideology about account type is usually less useful than a flexible structure that gives your future self room to maneuver. Young workers often underestimate how valuable Roth space can be when they are in relatively low earning years. Peak earners often underestimate how valuable a current deduction can be when cash flow and tax load are heavy. The important thing is not tribal loyalty. It is understanding that taxes are part of capital allocation, not an afterthought. Now, let me show you one of the most underappreciated tools in the whole operating system. I call it the medical war chest. Most people hear health savings account and think of receipts, pharmacies, and administrative nonsense. That is exactly why the opportunity exists. The best financial tools are often ignored because they arrive wearing boring clothes. An HSA can be an extraordinary vehicle if you qualify for one. Why? Because it offers a rare trifecta. You can receive a tax deduction on the way in, the assets can grow without annual tax drag, and withdrawals for qualified medical expenses can come out tax-free. 3 layers of advantage in one structure. That is not small. That is elite design. For 2025, the contribution limits are meaningful. Again, roughly $4,300 for individual coverage and $8,550 for family coverage. But eligibility requires a high deductible health plan, and that is not right for everyone. This is where intelligence matters more than slogans. A powerful tool in the wrong hands or under the wrong circumstances is not a strategy. If your medical usage is heavy, if the plan fit is bad, do the math honestly. Do not force a tool because somebody online called it a hack. But for the right person, the HSA is a quiet monster. Here is where the logic gets even better. If you can afford to pay current medical costs out of pocket and let the HSA remain invested, you are not just covering health expenses. You are building a tax-efficient reserve for one of the most predictable cost centers of old age. Most people spend their youth underestimating how expensive the back half of life becomes. Medical costs are not a surprise category. They are a near certainty. Building a separate war chest for that reality is not pessimism. It is rationality. There is an additional layer most people overlook. If you keep the receipts for qualified expenses, reimbursement does not have to happen immediately. You can pay today, save the documentation, and reimburse yourself years later. That means the money can stay invested longer. Time inside a tax-advantaged container is valuable. Do not waste it just because you never bothered to learn the rules. After age 65, the HSA becomes even more flexible. Non-medical withdrawals are allowed, though taxed like a traditional account. But the real beauty remains the same. Medical expenses in retirement are not hypothetical. They are coming. Building an account that can meet them with tax-free dollars is one of the cleanest pieces of financial engineering available to ordinary people. I have seen projections showing that consistent HSA contributions compounded over decades can create a sum large enough to neutralize a huge share of retirement healthcare costs. That matters because healthcare is one of the great fear engines of old age. If you can pre-build a dedicated reservoir for that category, you do not just improve your finances, you improve your peace. That is what mature wealth does. It buys lower cortisol. It reduces the number of things that can corner you later. Once the tax shelter stack is working, you return to the workplace plan and push further. The first dollars open the free money gate. Now additional dollars strengthen the shield. For 2025, the 401k limits are large enough to matter in a serious way, roughly $23,500 for most people, with higher amounts available for those eligible for catch-up contributions. That kind of sheltered annual flow, repeated year after year, becomes a different class of compounding. This is the point where many people fall off. Not because the system stops working, but because the discipline required becomes visible. Most Americans save too little to fill even the early layers. That is why so many financial conversations sound delusional. People are debating advanced tactics while still failing the foundational layers. They want the aesthetics of wealth without the operating discipline. Do not be one of them. Do the boring layers so well that the advanced layers become natural. If you have built the survival floor, extinguished the interest fire, claimed the free money gate, and stacked your tax-advantaged accounts intelligently, you are no longer playing the same game as the average person. Your money is not merely being saved, it is being routed through a structure designed to preserve more of its force. And only then do I want to talk seriously about the place most people insist on starting. The open taxable account. I call this layer the freedom bridge. Notice what I did not call it. I did not call it the magic button. I did not call it the exciting zone. I did not call it the millionaire portal. I called it a bridge. Because its best use is not fantasy. Its best use is flexibility. A taxable account matters because life does not always line up neatly with retirement rules. Maybe you want to buy a house in 5 years. Maybe you want optionality before traditional retirement age. Maybe you want capital available without penalties or contribution limits. Maybe you want to leave appreciated assets to heirs who may benefit from a step up in basis. All of that is real, but do not mistake flexibility for superiority. Taxable accounts live out in the weather. Dividends can be taxed. Realized gains can be taxed. Bad behavior is easy. Impulse trading is easy. Story-driven speculation is easy. The open architecture seduces people into believing more options equal more intelligence. Usually the opposite is true. More options often mean more mistakes. This is why I hate seeing people rush here first. They open a taxable account with no emergency fund, expensive debt, missed employer match, empty IRA space, ignored HSA opportunity, and underused 401k. Then they start asking whether they should concentrate in some hot theme. That is not smart. That is a man trying to decorate the attic while the basement floods. Tax drag is not abstract. Over decades, it can cost extraordinary sums. If two people invest the same amount and earn the same gross return, the one inside tax-protected structures can end up dramatically ahead, simply because less capital was scraped away along the journey. People underestimate this because they think in annual snapshots. Wealth is not annual. Wealth is cumulative. A small yearly drag becomes a large lifetime wound. There are illustrations showing that investing $10,000 a year for 30 years at 7% can produce radically different results depending on whether the money compounds inside a tax-advantaged structure or inside a taxable one with friction along the way. The spread can reach into the hundreds of thousands of dollars. Most people will work for that kind of money longer than they would ever spend learning how to route the dollars correctly. This is why sequence matters so much. You do not begin on the freedom bridge. You earn your way to it by securing the layers beneath it. Now, there is a dangerous psychological mistake I want you to avoid. Once people hear a sequence like this, they turn it into a checklist and miss the deeper lesson. The deeper lesson is not simply where the next dollar goes. The deeper lesson is that capital behaves differently depending on the environment you create around it. One environment forces liquidation, fuels interest expense, misses free money, and feeds taxes. Another environment absorbs shocks, kills drag, captures subsidies, and shelters compounding. Same worker, same salary, different operating system. That is why one person can earn a decent income for 20 years and feel trapped, while another person with similar income ends up with calm, options, and negotiating power. It is not always brilliance. Often it is order. I have watched people spend immense energy trying to pick superior investments while tolerating inferior structure. They want a 10-bagger because they have never learned to respect sequence. But the truth is, one of the greatest multipliers in personal finance is not an exotic asset. It is doing the ordinary things in the right order for a very long time. This is where the contrast becomes brutal. The average person thinks investing begins when you buy something. I think investing begins when you stop doing the things that sabotage ownership. The average person thinks saving cash is dead money. I think strategic cash is what keeps you from becoming a forced seller. The average person thinks debt payoff is separate from investing. I think expensive debt payoff is one of the highest certainty returns most people will ever touch. The average person thinks employer plans are paperwork. I think a match is a subsidy that only the careless decline. The average person thinks taxes are an accountant's problem. I think taxes are a capital allocation problem. The average person thinks flexibility means having every option available. Now, I think flexibility means having enough structure that future choices are not made under duress. That difference in viewpoint eventually becomes a difference in destiny. You can see it in households everywhere. One family carries invisible stress because every unexpected cost is an event. Another family has systems. The first family debates purchases emotionally. The second family has already built layers that absorb pressure. The first family thinks money is about how much comes in. The second knows that money is also about what leaks out, what gets taxed, what compounds, and what remains available when the world gets ugly. I want you to build the second kind of life, not because it sounds respectable, but because it gives you control. And control is more valuable than status. People spend far too much of their lives renting peace from employers, lenders, and market conditions. They act secure while their finances are one inconvenience away from chaos. Then they call that normal. It may be common. It is not normal. It is fragile. A proper investing sequence is really a sequence for reducing fragility. First, you stop being easy to knock over. Then you stop paying usurious prices for yesterday's mistakes. Then you accept the free capital your employer is willing to hand you. Then you route your money through the smartest tax shelters available. Then you use the taxable world as a tool of flexibility, not as a casino. Do you see what this does? It transforms money from a series of disconnected actions into a coherent system. It takes you out of reactive mode and puts you into allocator mode. You stop asking, what should I buy right now, and start asking, what layer of my operating system is still underbuilt? That question is worth a fortune because it forces honesty. Maybe you do not need another stock idea. Maybe you need $2,000 in cash. So a bad month does not turn into a bad year. Maybe you do not need a complicated portfolio. Maybe you need to stop paying 22% to a credit card company that is quietly outperforming your investments. Maybe you do not need a side bet on the next hot industry. Maybe you need to open the paperwork from your employer and capture the match you have been too lazy to claim. Maybe you do not need more market commentary. Maybe you need to understand why leaving IRA room unused and ignoring an HSA is like refusing a legal tax shield because you preferred entertainment to structure. Maybe the reason you do not feel wealthy is not because your returns have been poor, but because your operating system has been sloppy. That is a harder message than just saying work hard and invest more. But it is more useful. Work matters, income matters, ambition matters, but sequence determines whether those things build a fortress or disappear into sand. And I want to say one more thing that people rarely say clearly enough. None of this is about perfection. You do not need to wake up tomorrow and become a flawlessly optimized financial machine. You do not need to max every account instantly, eliminate all debt in a month, and build a full emergency reserve by next Friday. That is fantasy. What matters is that you stop lying about the order. You stop pretending speculative excitement can substitute for structural discipline. You stop acting as if a brokerage purchase erases a broken foundation. Your next dollar has a job. Your next bonus has a job. Your tax refund has a job. Your raise has a job. The question is whether you will assign those jobs intelligently or keep scattering capital in ways that feel productive while leaving the true bottlenecks untouched. Most people never become rich enough to overcome chronic disorder. They have to solve it early. They have to solve it at ordinary income levels while the stakes are still manageable, while the habits are still malleable, while the math is still on their side. If they do not, higher income often just scales the confusion. A larger paycheck poured into a broken operating system does not create wealth. It creates a more expensive mess. That is why I care so much about order. Order is what turns average earning power into durable freedom. Order is what turns small annual contributions into large future leverage. Order is what keeps you from selling low, borrowing high, missing subsidies, and feeding the tax machine more than necessary. Order is what lets compounding do its work in silence. And silence is where real wealth is built. Not in the noise, not in the bragging, not in the thrill of calling a market move. In silence, in the patient routing of dollars toward the layer that most strengthens the system. If you follow that discipline long enough, something remarkable happens. Money stops feeling like a monthly emergency. Investing stops feeling like a personality trait. Accounts stop feeling like random buckets. Your financial life begins to feel integrated. Stable, purposeful, capable of absorbing shocks without drama. That is when wealth starts to look less like a number and more like a form of private power. Private power is the ability to say no, no to bad debt, no to panic selling, no to jobs you hate purely because you failed to build buffers, no to the government's unnecessary annual skim where legal shelters were available, no to the false urgency of market noise, no to a life in which every setback becomes a negotiation with fear. That is what the proper investing order can buy you if you respect it. Not just a larger account, a stronger negotiating position with life itself. So here's the final test. If I looked at your finances today, would I see a coherent operating system, or would I see apps piled on top of instability? Would I see a survival floor, or would I see hope masquerading as strategy? Would I see the interest fire under control, or would I see you trying to invest with your future already pledged to lenders? Would I see the free money gate open, or would I see employer subsidies left untouched because paperwork bored you? Would I see a tax shelter stack built with intention, or would I see taxable noise-receiving dollars that should have been protected? Would I see a freedom bridge used wisely, or would I see a casino built where a bridge should be? Be honest, because the answer is not theoretical. It is already shaping your future. Every month you keep the wrong order, you pay tuition to chaos. Every month you restore the right order, you buy back control. And at some point, whether sooner or later, you are going to face a choice. You can keep pretending investing is about finding the next exciting thing to buy, while the real leaks, fires, and missing permissions stay exactly where they are. Or you can build an operating system that makes wealth more likely, fragility less likely, and freedom less dependent on luck. One path gives you market stories. The other path gives you a life that can survive markets. Choose carefully, because the market is not the first test. Your order is.